Ever wonder how Warren Buffett built his entire empire? What if you could boil it all down to just a handful of key decisions? Well, that's exactly what we're going to do. We're unlocking the playbook behind his most legendary trades to show you the surprisingly simple lessons that made him, well, him.
And that right there, that's the absolute core of it. His success wasn't about jumping on the latest trend or following what everyone else was doing. Nope. It was about making a few huge, extraordinary bets and having the guts to see them through.
So, what's the secret sauce? How did he actually do it? Well, it's not some crazy complex algorithm, I can tell you that. It's really just a set of simple, incredibly powerful principles. And today, we're going to break them down one legendary trade at a time. All right, lesson number 1. This is the bedrock of his whole philosophy. Invest in brands that last. Buffett figured out that the most powerful asset a company has, it's not on a balance sheet, it's right here, in the minds of its customers. I want you to picture this. It's 1988. To Wall Street, Coca-Cola was just a snoozer, a boring, slow-growth soda company. But where the market saw stagnation, Buffett saw this hidden giant, just waiting. And listen, we're not talking about a small bet here. He went all in, pouring over $1 billion into the company. Now, at the time, this was an absolutely jaw-dropping move. He was staking a huge chunk of his firm's capital on this one single idea. And the payoff? Well, that one single bet has exploded to over $25 billion. And get this, that's before you even count the dividends. That, my friends, is the power of ignoring the day-to-day noise and focusing on timeless value. The key insight he had was so simple, but so profound. He wasn't just buying a stock. He was buying a global habit. He understood that the real asset was Coca-Cola's unshakable place in the daily lives of literally billions of people. Now fast forward a few decades and guess what? He runs the exact same play with Apple. While Wall Street was obsessing over iPhone specs and quarterly sales numbers, Buffett looked right past all that tech stuff. He saw a modern-day Coca-Cola, a powerful consumer brand with absolutely ferocious loyalty. And this really gets to the heart of the lesson, doesn't it? Technology, it becomes obsolete. But real, genuine customer loyalty, that's durable. He wasn't betting on the next iPhone. He was betting on the entire Apple ecosystem. So, you've found a great brand. Awesome. But when do you pull the trigger? That brings us to lesson 2, which is Buffett's classic mantra, be greedy when others are fearful. He knew that the absolute best prices are found right in the middle of a full-blown panic. Just take the salad oil scandal back in the 60s. A massive fraud case sent American Express stock into a total nosedive. The market was panicking, convinced the company was completely finished. So what did Buffett do? He completely ignored the noise from Wall Street and did his own simple research. He literally went to restaurants and shops and just watched. And what he saw was that people were still proudly pulling out their Amex cards. The scandal hadn't changed customer behavior one bit. This is such a core Buffett principle. You have to separate the stock's story from the business's reality. When customers stick around even when the news is bad, the underlying business is probably a heck of a lot more valuable than the stock price is telling you. And it wasn't a one-off. He did it again in the 1973 market crash. The panic was so extreme that the Washington Post, a fantastic business, was trading for less than the value of its own buildings and printing presses. The market was basically giving the company away for free. And that's the takeaway, right? Widespread fear creates irrational prices. An investor who can just stay calm and focus on the real value of a business can find some incredible bargains in the wreckage. Okay, so you've got a great brand, and you bought it during a panic. But how do you know it's going to stay a great business? Well, that brings us to lesson number 3, the economic moat. This is that structural advantage that protects a company from all its competitors. You know, the origin of this idea goes way back to when he was just 21 years old. He took a train to Washington, D.C., and on a Saturday, he just started knocking on the door of Geico headquarters until a janitor finally let him in. What he learned that day, it would change his life forever. He discovered GEICO's moat, a brilliant, simple business model. See, by selling insurance directly to people, they cut out the middleman. And that created this permanent cost advantage. Their competitors couldn't copy it without destroying their own businesses. The lesson here is crystal clear. Find a business with a moat that's hard to cross, and you've found more than just a good stock. You may have found a lifetime investment, a compounding machine you can just own for decades. So we have the three key ingredients, right? An enduring brand, bought during a moment of fear, and protected by a deep, unbeatable moat. Now let's put it all together into the final formula.
The playbook is almost deceptively simple. Step 1. Find these incredible businesses with strong brands and deep moats. Step 2. Buy them when market fear makes them cheap. And step 3, this is the hardest part of all. Do nothing. Just hold them for decades and ignore all the noise.
When you look back, the pattern is just so clear. Buffett never won by trying to predict what the market would do next or guessing on quarterly earnings. He won by simply identifying superior businesses and then having the patience to own them. It all comes down to one of his most iconic quotes. This just perfectly captures his entire philosophy. The ultimate advantage in investing isn't having a super high IQ, it's having the right temperament. It's about patience. It's about letting your best ideas compound over time. Buffett's lessons are absolutely timeless. But, he's not the only master of the game. So who should we break down next? Let us know what you think. Are you on Team Munger, Team Lynch, or Team Dalio? We'll see you in the next one.